the debt reduction plan going forward. Let's get on to our value pick segment. I have Mayuresh Joshi from Angel joining us. Mayuresh, happy Diwali to you. Thanks for joining us. My first question is the investment rationale for the stocks that you have picked up. What are the themes that you have based it on?
Morning, Mini. Clearly, I think a very happy Diwali to you, the entire team at Bloomberg, and all the investors, hoping a healthy, wealthy, and a prosperous one as well. So the general theme, Mini, is a sort of a bottom-up approach where we believe that the earnings for all the companies under our recommendations should do pretty well over the next 4 to 6 quarters. And again, I think a few valuations might look a tad expensive, but if you do a peer comparison check, our take is that those premiumization valuations should sustain for a lot of these companies. So they've gone through their cyclical downturns, but they've emerged stronger out of the entire downturn that we probably witnessed. So any upturn that we probably see over the next few quarters, these companies will exhibit stronger earnings growth, which will ensure that their earnings potential and their price multiples sustain the premium valuation that they are deriving.
Okay. I'm going to pick up some of the stocks that really stand out for me. First is Larsen & Toubro. You know, the stock's taken a knock, Mayuresh, after the recent projections and the commentary from the management. What do you like about it? What's your target for this?
So clearly, Mini, I think the stock has got hammered down after the results, and rightfully so. I think the order book size, as we witnessed in Q1, Q2, clearly showed that the order book guidance will be rotated downwards, and that's what precisely happened to 5 to 7%. But clearly, I think if you look at the cyclical recovery that one really expects with the economy and the capex upturn that one really expects to come through the next few quarters, L&T will be a key beneficiary on both these counts. Infrastructure probably has struggled in terms of how the EBIT margins panned out to 8.6%. But clearly, I think the order book is quite substantial. The non-core asset sales is going to be a huge positive for L&T, and the management has indicated a few of these going through over the next few quarters. Clearly, I think even in terms of numbers, the FY16 might be a little bit tough, both in terms of order flows and revenue guidance as well. I think FY17, if one really expects the capex cycle to turn, L&T will be a big beneficiary both on the infra segment as well as the hydrocarbon segment. So clearly, L&T, based on how the capex cycle might turn, and even in terms of valuation after the correction, looks like a very strong play on the infrastructure stroke construction side.
ICICI Bank and Axis Bank is what you like from the banking space. You know, Axis has actually slipped into the red in terms of returns. We had seen such a flurry of activity in the private sector banks. Mayuresh, why do you like these two stocks? Because both have been pretty badly hit.
Clearly, again, yes, I think the numbers were disappointing, and again, the ARC sale has badly hit Axis Bank. But clearly, we believe that the peak off in terms of how the slippages will pan out would more or less have happened on Axis balance sheet. The exposure probably for Axis, ICICI in terms of infrastructure loans is a well-known fact. But clearly, if you look at capital adequacy, if you look at their branch network, if you look at their CASA spread, I think it's very well diversified within the private space. And though direct comparisons cannot be made with HDFC Bank, which is more retail-oriented, our take is that the asset quality should more or less stabilize year on. And clearly, I think if you look at the branch network as well, I think a lot more positives can be built in, both in terms of how the NI growth will take place as well as the non-interest income growth. So clearly, operating out of their branch network, the operating leverage benefits coming through, and if you adjust the values of subsidies, I think the price to adjusted book for both Axis and ICICI look pretty attractive. So based on all these parameters, we think that these banks can do very well over the next 12 to 15 months.
LIC Housing Finance is the other stock that you like. NBFCs have done very, very well. How much of an upside do you see in a stock that's already given about 24% returns over the last 1 year?
Oh yes, and we did like LIC right from those levels that we had witnessed way down over the last few months. But clearly, I think if you look at how the trends are panning out, the cost of funds have clearly gone down to 9.29%. The yield on investment should more or less stabilize, which means that the spreads that LIC Housing enjoys should continue to enjoy. The cost to income ratios are probably low. And again, I think if you look at the kind of asset quality that LIC Housing has got, I think it's very stable across economic cycles. So the developed portion is pretty minuscule at 2.5%. And at 0.6 gross net asset ratio, at 0.33 net asset ratio, we believe that once the good time starts and interest rate cuts start happening and percolating through the system, the demand for advances should grow at a pace of more than 18 to 20%, and more on the retail side, which should grow in excess of 20%. So LIC being a clear beneficiary out of the retail advance growth should benefit humongously from the advances growth that you might probably see with interest rate cuts going down. And clearly, even from the valuation perspective, we believe valuations compared to historical valuations are quite fair at 2.4 times.
Fair enough. Hold your thoughts, Mayuresh. We'll head into a short break. We'll come back with a couple of the other bets that you are making. One is very interesting because Ashok Leyland has run up so much. I don't know how much returns you're expecting from the 83% returns it's already given over a one-year period. But we'll come back and discuss the same with Mayuresh. Do stay with us. Welcome back. You're watching our Diwali special. The markets are still down, but we are talking value picks in this market with a one-year horizon. And still with us is Mayuresh Joshi from Angel. Mayuresh, we discussed Larsen & Toubro and the two private banks that you like, which is ICICI Bank and Axis, along with LIC Housing. But I'm going to talk about the other stock that you like, which is Ashok Leyland. After an 83% increase in the last 1 year, what is the story that's going to take it up another, say, whatever percentage that you are expecting it to gain?
So clearly, as I mentioned earlier as well, I think the premiumization story should continue for a few players, and Ashok Leyland has been a key beneficiary of the MHCV cycle. The market share is close to 28-29% for Ashok Leyland, and with MHCV volumes rebounding, Ashok Leyland volumes have also rebounded for the better. So the better part of the next couple of years, our take is a 15-18% growth in terms of volumes, specifically in the MHCV segment. On the MCV segment, I think it's been a laggard of sorts, but with the last mile connectivity and activity expected to pick up as the capex cycle evolves over the next couple of quarters, the LCV activity should also start resuming its uptrend. So the consolidated numbers should probably start looking a lot more better in FY17. The export component, which is around 15%, our own take is with African countries importing a lot more. The export component should increase to 30-33% for Ashok Leyland, which will also ensure that the margins sustain at the higher levels. Our own take is the operating margin should sustain at 11-12% mark, and clearly with input costs going down, I think it should be a clear beneficiary. With diesel prices going down, the fleet operator profitability should probably start ticking up, which will be a key beneficiary factor for Ashok Leyland as well. So in terms of valuations, I think it's not so cheap any longer at 11 times EV EBITDA, but our take is that with expected volumes to increase on the LCV front, specifically from Patnagar, and MHCV segment showing rebound, a justification in terms of EV EBITDA multiple should sustain. So our target over the next 12 months stays at 111 for Ashok Leyland with an EV EBITDA multiple of 13 times at that value.
Okay, fair enough. Amara Raja Batteries, the auto ancillary space is what you like. Again, stock which has not done badly in the year or year-to-date period. What is the upside do you see over here?
It's a simple peer comparison, Mini. So I think if I compare Amara with Exide, Amara has gained market share quite significantly over the last few years. Its market share currently stands at 35%. And even if you look at the way the sales have grown for Amara over the past few years, they've grown at a very humongous pace. We still expect the kind of volume growth that Amara has posted to continue with an 18-19% volume growth, which effectively means a top line growth of 18% over the next couple of years, close to that 5,870 odd mark. In terms of how EBITDA margins might pan out with lead prices falling and expected to stabilize around the current levels, the OPM should be anywhere between 17.5 to 18% for Amara Raja. And clearly, even on the bottom line, I think there should be a sufficient amount of growth probably coming through with operating benefits coming through. So clearly at multiples of 24 times, again, I think no longer cheap if you do historical comparisons. But again, the premiumization compared to their peers and specifically Exide, Amara Raja should still continue enjoying market share gains, and that will probably justify the premium valuation that it is getting.
In the pharma space, Mayuresh, you only like Ipca Labs. Now, the view on Ipca Labs has been a little negative. In fact, from a year-to-date perspective, that stock is an underperformer. And if you look at the rest of the pharma pack, especially the mid-cap pharma counters, they've been huge performers. Why do you like Ipca Labs?
So clearly, I think it has underperformed greatly, as you rightly mentioned, for the past 1 year. But clearly, if you look at the FDA concerns why the stock got beaten down, our take is that FY16 probably has factored in a lot worse than what the numbers are suggesting. So I think the numbers were relatively better than what we were expecting, at least for this quarter. And clearly, the management focus has been to shift from the low-margin malarial business to the high-margin chronic lifestyle businesses like CNS, CVS. And clearly, that is going to have a huge impact on how margins will pan out for Ipca. Any resolution on the FTA front specifically related to its plants is going to be a huge kicker for the stock going forward. And the normalization of ROEs in excess of 25-26% should resume if that probably comes through over the next few quarters. So clearly FY17 in our opinion will be where numbers will start playing out more meaningfully for it collapse. And again, I think valuations are not looking that demanding or stretched at this point of time.
From the tech pack, you like HCL Technologies and Infosys. Why?
So clearly, I think both these stocks have given divergent results this time around. Infosys gave a brilliant set of numbers, but the management commentary indicated headwinds probably getting faced generally by the IT sector and Infosys in particular. If you leave aside Q3, Q4, our take is that for the better part of FY17, and again we've taken a very conservative approach for Infosys, 11% growth both in dollar and rupee terms on a compounded basis. But clearly I think there is every scope for utilization levels to inch up for Infosys. The kind of order wins that Infosys is doing, the client mining activities that they are doing, the kind of control over attrition that it has achieved, I think that is much more meaningful and achievable even on a faster scale going forward. So Infosys at around 17.8 times looks relatively attractive to us at this point, and we see meaningful upside over the next 1.5 years. Similarly for HCL Tech, again I think IMS has been a weak link, and again I think a lot of questions raised about how the performance might be, but TCV deals consistently of $1 billion every quarter holds it in good stead. Engineering contributes almost 18%. It's a high margin business and the management is highly focused on increasing market share gains from that segment itself. The application services business also is expected to do relatively better over the next 12 months. So clearly even HCL Tech in terms of how the earnings might pan out at 13.5% in terms of constant currency growth, and again valuations look exceedingly attractive to us at this point of time.
Okay. The next two stocks are Inox Wind, a recent IPO, and Jagran Prakashan. What do you like about Inox Wind? I know there's a huge build-up plan on the renewable space, and you're not the only brokerage which is saying buy Inox. But how much of an upside do you see from here, and what's your investment thesis here?
So clearly, I think the order book is quite decent. That's point number one. Around 1250 megawatts per order. The kind of orders under acquisition or sites under acquisition is close to 4,500 megawatts. I think there is enough revenue visibility in terms of the next 12 to 24 months. Point number two, I think the government focus is quite clear when it comes to the renewable energy pack, and clearly I think Inox Wind is going to be a key beneficiary out of that. Point number three, probably the kind of capex that Inox Wind has already done. I think the utilization levels are expected to inch up. There's going to be no royalty payment from FY16 onwards, and that's going to have a telling effect on a positive note on the bottom line. When it comes to margins, our own take is 17.5-18% range should be maintained for Inox Wind, and they're going in for higher diameter blades, which basically ensures high realizations going forward from the end customer that probably caters to. And fifth, I think the kind of growth that we really expect in terms of top line, a 48% growth on a compounded basis over the next couple of years, which was effectively result in a huge bottom line going forward. Valuations again looking extremely attractive at this point of time. So Inox is something that we probably prefer from the renewable energy space. For Jagran, I think market leader within the print media space, number one publication on the Hindi side, Dainik Jagran, Inqilab, which is the number one Urdu selling in the country. The Radio City business that it's recently acquired, I think the PAT margins at 22.5% are extremely attractive in our opinion. And again, I think the kind of advertising growth of 27% that the company has posted, the management is very, very intentful of maintaining that run rate. So even if you take a run rate of around 20-22% going forward, circulation revenue is expected to pick up to 8-10% going forward. RTK's consolidated numbers should appear far better for Jagran. And again, valuations at 14 times at the current juncture, I think seem extremely attractive to us. I think Jagran is something that we also like within the print media universe with a target of 170 over the next 12 months.
Okay. Last question, Mayuresh, and very quickly. This is the first Diwali in 5 years that we're going into the Diwali day with such a weak showing, both in a 1 month scale and a 1 week scale into Diwali. My question to you is that how is the rest of the year looking? What is your December end target? Because you've got two news pieces. One is a very volatile, perhaps, Parliament session. And the second is the whole Fed liftoff, which is likely to happen, perhaps, some people say by December. On the whole, what's your year-end target? I'm talking about the calendar year-end target for the Sensex and Nifty.
So clearly, I think we're still maintaining our estimates around 31,000 on the Sensex for March end. But clearly, I think uncertainty will keep on playing a spoil sport for the markets. Clearly, what has happened with Bihar, I think a lot more focus will be laid on how the economic policies will evolve over the next few months. What happens with the winter session is going to be extremely crucial in terms of how key bills are going to get perceived, whether they're going to get passed or not. What happens with the Fed? Again, I think if a paid rate hike does happen in December, I think you're going to see some amount of reaction happening onto the markets. And even if a lot of participants feel it's largely factored in, I think once the event takes place, you will see some amount of sell-off happening. So our take is that the markets, in terms of how earnings are panning out, we do not see recovery happening in terms of earnings, at least for the first half of FY17. And if you map earnings with the kind of valuations the Sensex or Nifty is deriving at this certain juncture, I think it's fairly priced. So our take is 7,500, 7,600, 8,200, 8,300 is a broad range for Nifty. But again, any positive developments over the next couple of years, or next couple of months rather, I think you'll see a positive uptick happening on the Nifty by the end of the month, by the end of the year.
Okay, Mayuresh, we leave it there. Thanks so much for joining us with that, and a happy Diwali once again to you. With that, it's a wrap on Bloomberg Bottomline. Thank you for joining us. Goodbye.